Wires and cables, our core business grew 6% year-on-year. The domestic business performed relatively better, with wires posting healthy double-digit growth, while cables closing around last year levels. B2C wires continued strong traction led by distribution expansion, festival-led renovation activity, and gain from unorganized segments. Institutional business continues to face headwind from slower project activity and investment. However, distribution business held up well. Our exports business declined by 33% year-on-year, trotting a high base of a large order from Dangote Group, which amounted to rupees 1.4 billion in Q3FY21 and rupees 3.2 billion in base quarter. Ex-Dangote, exports portfolio continues to see good momentum, increasing at 29% year-on-year, led by Australia, Asia, and the UK. OFC business remains sluggish. However, our spatial cables division has seen good progress as we receive approvals for cables to be used in defense, railways, and EVs. We also commenced supplies of in-house manufactured high-end cables used in commercial and passenger vehicles, which are currently being imported to a great extent. On the profitability side, sharp commodity inflation was a boon and bane. While it did aid to our realization, it also created some input cost pressure. Segment EBIT margin stood at 13.5% in Q3. On slide 7, FMEG is continuing with its growth trajectory. Revenue growth in Q3 was 41% year-on-year. The segment contribution to overall sales increased by 215 basis points year-on-year to 10.8%. Apart from the competitive intensity, FMEG business faced many challenges like unavailability as well as sharp rise in input costs, supply chain, and logistic issues. Despite that, beyond consumer sentiment and our excellence in market operation led to healthy demand for our products across categories and regions. Within FMEG, fans grew strongly, gaining leadership position in few geographical clusters. Overall demand for lighting products remained upbeat, led by festive season. Switches and switchgears witnessed healthy growth with resumption in renovation activities and improving situation in real estate. On the profitability side, segment EBIT margin increased from 0.6% in Q3 FY20 to 5.9% in the previous quarter, despite higher A&P spend and raw material inflation, led by cost-saving initiatives, pricing action, and improved product mix. For the first 9 months of FY21, FMEG sales is back in growth orbit, while segment margin has increased by over 200 basis points to 4.7%. This is commendable achievement considering the first quarter of this year was a nearly a washout with adverse operating leverage. On slide 8, other segments which largely comprise of our strategic EPC business witnessed a decline on account of a higher base. Revenue was thus down by 53% year-on-year to rupees 614 million. EBIT stood at rupees 86 million, down 71% on year-on-year basis. The copper segment, as disclosed in financial results, largely reflects Riker Base, which is our wholly owned subsidiary. On slide 9, let me introduce to Home. It is a new brand from the house of Polycab, comprising of a premium IoT-based FMEG portfolio, which will cater to evolving needs of consumers in this digital age. All of Home products are made in India. They are currently being launched in a phased manner in top 10 cities. By next month, we expect it to be available online as well. Home is a significant step in our journey of innovation and transforming Polycab into an aspirational brand. On slide 11, Polycab was recently featured as a case study by the prestigious British Approval Service for Cables. Our swelling portfolio of global quality certification proves our commitment to quality, consistency, and credibility. We also launched several consumer electrical accessories, new range of economy premium fans, and several differentiated products across categories during the quarter. Moving on to financials from slide 11 onwards, our fundamentals and return ratios have strengthened. Our net cash position at over rupees 13.3 billion has doubled, while debt to equity ratio remained at a comfortable level of 0.06 times. ROCE for Q3 FY21 stood at 30.6%, in line with last year. On the working capital side, we continue to drive channel financing, which is helping reduce receivable days. Our work on inventory optimization is materializing as reflected in the imported raw material levels. Having said that, we aim to further improve it while maintaining a file balance with payables, which will result in better working capital management. On the distribution side, we are taking significant leaps. As of December 2020, we have over 4,000 authorized dealers and distributors, catering to over 150,000 retail outlets. Our key influencer connect program, that is Project Bandhan, now touches over 170,000 electricians and over 50,000 retailers. Over the past decade, we endeavored to build a robust distribution network, which now spans across all states and union territories. We are now upping the ante with Sales Acceleration Program. This program adopts a 360-degree approach while combining channel expansion with robust influencer management and process improvement. Our go-to-market strategy will be underpinned by thorough market and channel assessment, redesigned policies and procedures, and all supported by real-time data analytics. We believe this program will significantly augment our reach in B2C business. It is currently implemented in 5 towns, and we aim to reach 300 towns over a period of 3 years. Our work to penetrate in lower tier towns, semi-urban and rural continues, and we are quite optimistic that the efforts will pay off well over the medium term. Our work on developing a 5-year plan or Vision 2025, which I alluded to last time, is progressing well. Hopefully by next quarter, we should be able to wrap up the exercise and share our thoughts with you. We have also put in significant efforts for meticulously aligning individual goals with company goals through an upgraded, robust performance management system. We are extensively focusing on tapping the power of modern technology and implementing it across all facets of our business. These initiatives will be stepping stones of healthy growth over mid to long term. There is one recent development which I will probably highlight. Mr. Sai Narayan, who was our company secretary and compliance officer, tendered his resignation on Saturday and the board has accepted it. It was a mutual decision considering he is 64 years younger now. We thank him for all his contribution to company made over the last year. Manita Gonzalez, who was head of legal, was promoted as new company secretary and compliance officer. This change was a part of our succession planning and the transition was in progress since last year. Lastly, we will strive to improve the momentum we have created with unfolding market recovery. Our actions and initiatives are aligned with our strategic priorities, which will enable us to lead the pack and deliver healthy returns to our long-term shareholders. With this, I hand over to operator and we can open the floor for Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Bookkeeping question. The wires and cable revenue in the press release is 2,400 crores, whereas in the PPT is 2,200 crores, 270 crores. So, what's the difference there, sir? So,
that's because of inter-segment elimination. Any transfer between Polycab India to Riker required elimination, and that is the reason why it has been eliminated.
Okay, that difference is that intersegmental of 200 crores, 200 odd crores, which is shown below the total of all the segments.
Yes. And if you wish, Ravi, you can peruse the condensed financial statement, which has been posted on our website as well as available on the stock exchange website, where you would be able to see the detailed reconciliation, which is given under segment reporting.
Got it, sir. Got it. And secondly, with respect to our gross margins, it has been say roughly around the 200 bps compression. more than 200 bits, around 300 bits compression. So is it because of the fact that the export Dangote order has come down in revenue and that carries better margins? And that is also one thing, and commodities going up, that's also one thing. So
I think the real reason is because of commodity. I don't think that Dangote has any major role to play in this contribution. As I alluded to in my opening remarks, across the board, all the raw material prices increased very significantly in last 3 months between September to December quarter. Copper and aluminium both increased almost by 15%, and PVC has increased almost by 50%. So what we did is we took a conscious call not to pass on all the cost inflation considering the market environment, as well as leverage benefits which we would expect coming because of better demand momentum. And on consolidated basis, the overall cost impact was in high teens. We increased our prices in low teens, and there's a delta. And because of some mix and change as well, there's a delta which is getting reflected in contribution margin. But having said that, you know this for sure that we have always maintained that we have been playing between 11 to 13% of EBITDA margin cable and wire business, and we on annualized basis, and we expect that we'll continue to do that. On the FMEG side, the contribution as well as the EBITDA margins have improved. It's also getting reflected in the EBIT margins which were reported in December 20 results. And we expect that over a medium term, the FMEG margins will reach to high single digit probably within 2 years or so.
Got it. And it is still early days, sir. I mean, just 25 days gone in January, but copper prices have still been on a one-way direction. So is there any possibility of further price increases that we can expect in cables and wires? And next one is, so basically, how much amount of volume growth on a blended basis roughly could have been there this quarter, third quarter, in cables, wires and cables?
Yeah. So let me pick up the first one. You know the model, the way all the large players in this particular industry they are working. They generally take copper movement of the previous month as well as the foreign exchange rate movement in the previous month, and that is how they revise the sales price in the first few days of the month. We will continue to follow the same model. I think it will probably get impacted just because it got impacted just because there was a very significant increase in the cost. So I don't expect that there will be a significant change in the contribution margin, but wherever there is a scope, we will continue to take price hikes.
Got it. Yeah, thanks. Yeah.
Thank you. The next question is from the line of Devansh Negotia from Simple. Please go ahead.
Yeah, thanks for the opportunity, sir. So just had 2 questions. So one is in case of acceptances. So how does that work with regard to our raw material procurement? Because since we are holding cash and borrowing acceptances, which is in the nature of borrowing, so is there some kind of interest arbitrage? And second, if you can help us understand what is the interest percentage on the acceptances, and is it dollar denominated or in INR?
Yeah. So before I specifically deal with your question, let me give you a broad big picture how the metal procurement is done. Commodity and metal across the world comes with a zero credit period. And that means day one itself it becomes interest bearing, and that is what we do. These are the acceptances wherein the vendor gets borrowing from its bank, and we settle the liability 90 days or 120 days from the date of delivery. So that is how it works. It is not strictly a borrowing; it is acceptance, and that is where it is required to be treated differently in the financial statements. There is significant scope, because these are dollar denominated as well as these are LIBOR linked generally, whereas the Indian interest rate is significantly higher, and that is where you get a arbitrage benefit. But all along our objective has been to maintain and improve the working capital. You would have noticed that working capital has improved significantly over the last few quarters. And there are 2-3 things which we are trying to do, and that would probably help you understand what we are trying to do even on acceptances. One, on the receivables, we want to ensure that we increase the channel financing penetration, both in cable and wire and FMEG. In cable and wire, it is hovering around 60-65%, and FMEG it has increased to almost 25% now, which was around 17-18% last quarter. That will help us in reducing our receivables. On inventory, we were around 130 days or thereabouts the last quarter, and we have been able to reduce that to almost 109-110 days. Now, what we want to do is we want to further optimize the inventory levels and maintain payables in line with whatever inventory levels we have. That would mean that the net working capital would be nothing but a net receivables, which are expected to go down in the quarters to come. And that is how we want to monitor as well as optimize the working capital levels in the company.
Okay. And sir, so in case of acceptances, so based on last 3 to 5 years, the interest rate on acceptances is lower than the surplus cash that we earn through liquid funds? If that is the reason why we are holding it.
I mean, it would vary from quarter to quarter. I don't think I would be able to give you a generalized response, but overall, from the P&L perspective, it makes sense to carry acceptances to the extent it is broadly in line with the inventory, not beyond.
Okay. And in case of domestic cables, so given that infrastructure spends are robust, so is it a conscious decision that we are taking of not going very aggressive in the segment, or is there something else? If you can, just throw some light on that.
No, we are market leader and continue to be market leader both in cable and wire both put together. We are maintaining the same amount of momentum which is getting reflected in our top line growth as well. There are a few opportunities which are available where we could have done a slightly different, played a slightly different game. For example, in the case of cable domestic institutional business, where there is a bit of a slowness in overall demand, where we could have become a bit more aggressive. But there was also availability challenges of material because material cost had increased significantly, and then global logistic problems were there because of which containers were not available. But I think overall, if I take a balanced view, I think we are as aggressive as we are generally expected to be, and that's getting reflected in the top line as well. This quarter, incidentally, is the best quarter in the history of the company. 2,800 crore rupees of top line and 260 crore rupees of bottom line is best in the history of the company.
Okay. And any new order wins in exports or traction, if at all you can elaborate on that?
Yeah, continuously we are doing it. A couple of quarters back, I alluded to the fact that we want to move away from one-off orders like Dangote, and we want to have broad-based, sustainable export contribution top line. And expectation is that at least we should get 10% top line from export, which is what we have been able to achieve in this quarter as well. We are getting support from countries like US, UK, Middle East, and slowly and gradually we are venturing into new geographies. For example, Eastern Africa, Russia, and we are getting good traction from Asia as well. I alluded to the fact that the global organizations are taking notice and recognizing the quality products which we are manufacturing. For example, Basic also covered us in a case study and talked about the type of cables which we are manufacturing. So all these things will help us in improving the export top line. The second thing which is equally important is import substitute. In the current quarter, we have received some approvals from defense, railways, and some clearances on EVs. That will also help us in offering what is internally called import substitute, and that will also help us in improving our overall top line.
Okay. So that was quite elaborate. That's it for me.
Thank you.
Thank you. The next question is from the line of Aditya Bagul from Axis Capital. Please go ahead.
Hi, good afternoon, Gandharv, Vinder Bhai, and the entire team. Heartiest congratulations on a good set of numbers. Gandharv, I have 2 or 3 questions. First, if you can talk about the competitive intensity in the cables and wires industry, right? If you look at the last few years, we've grown ahead of the industry as a whole. I just wanted to understand how has that happened over the last 9 months, and what is our outlook for the immediate future, especially when we look at cables and wires in the domestic context. That's my first question. My second question is on the margins in the FMEG segment. Just wanted to understand if there is a huge difference in terms of margins of some of our mature categories like fans, which are now reaching close to double-digit levels, vis-a-vis some of the newer categories which are still in low single digits. So if you can throw some light on that, that would be helpful.
Thanks, Aditya. Thanks a lot for completing us, and I'm glad that you liked our performance. I think your first question was around the competitive intensity in the industry. I think we pick up any business, there would be always competition, and this particular sector is not an exclusion to that rule. I think 2-3 things which are important when we analyze cable and wire sector. One is overall the share of unorganized participant is reducing over the period, and I think the rate of reduction has trended in last few years. It started with Demon and then with GST, but particularly because of pandemic, availability of capital and cost of capital and availability of labor probably pushed the unorganized sector to a point where recovery is very difficult for them. So that is where all the large players, including us, is gaining some market share. And you know this already, Aditya. We are largest manufacturer of cable and wire in India. We enjoy almost 80-20% market share of the organized market. So that is where it's helping. I think there is a bit of a competition which is there, and but I think the fact is we have been able to achieve a decent amount of growth over the period in the current quarter reflects the aggression which we have followed, which is accepted from us. I think there are 2-3 things which are core foundation of our business. One is availability, and we have ensured that we continue to make investment and augment our distribution. As of now, we have almost 4,000 dealers and distributors, around 151,000 retailers, and we continue to make investment to do that. And I alluded to the sales acceleration program, which will further help us in augmenting our availability and top line. Second is quality, and third is cost, which is acceptable to the end customer. So we are maintaining on that, and I think that has helped. And the other thing is, a few years back and even earlier in this decade, I think there was a thought process in the end customer where cost was more important than quality. But over the period, I think things have improved. The end customer has started realizing the fact that good quality products mean safety, and that is where they don't mind spending some higher amount, and which is helping all the large players, including us. So there's some competitive intensity. And FMEG margins, this, Aditya, I alluded to this in the last quarter and a quarter before that as well. Our objective is to ensure that all the large sub-segments which we have in FMEG, for example, fan, light and lume, switch gears, we continue to make a good amount of top-line growth with healthy bottom line, and that is what is getting reflected in the bottom line of FMEG. For few small product categories, there, of course, the focus is there on a top line, but we are a bit more relaxed as far as the bottom line is concerned. So pipes and agro have been able to achieve a decent amount of top line growth. They are EBIT and EBITDA positive, but they are not as lucrative or as healthy as our other business segments. But over the medium term, in 2 years from now, I would expect FMEG on a combined basis to at least deliver single high-digit EBIT margins.
That is very, very helpful, Gandhar. Just one point of the competitive intensity. I was just trying to link your comment earlier that you've not passed on the full impact of higher input cost to the customer. So I was just trying to wonder whether it was linked to a higher competitive intensity, and hence you are looking for a better growth in Q4 and Q1, and hence we've not passed on the input cost. Is there any truth to that, or?
Yeah, I think we can attribute a part of it to that, but practically when there is a significant increase in prices, you have to ensure that there is no significant disruption in channel, and that is where you have to take calibrated pricing action. So there would be always a lag effect, which is getting reflected in this quarter. The other thing, on a consolidated basis, this, Aditya, we have a small copper business which has a significantly lesser contribution margin, which is also getting reflected in the consolidated numbers. So I think what you're saying is correct, but to only a certain extent or a small extent. By and large, it's the timing of the increase in the raw material cost and the sudden spike which is getting reflected in the contribution margin, coupled with the copper business which is getting consolidated because Icar is now a subsidiary which earlier used to be a joint venture.
Understood. Thank you. And I look forward to your 5-year vision in the next quarter.
Thank you.
Thank you. The next question is from the line of Naval Sheth from Emkay Global. Please go ahead.
Hi, thank you and congratulations, Gandharv, on the performance. 2-3 questions continuing from Aditya's question. As you stated that there is mismatch in terms of commodity price increase and lag in the customer price increase. So will it be the same scenario in 4Q also, where we would not intend to pass on the entire cost inflation to customer? That is first question. Second, on the new brand what you have launched, if you can share some insights on what kind of realization difference would be there as compared to the current portfolio, and what is the aspirational target, as this would be more of premiumization in terms of offering, going forward, how you are looking at it?
Yeah. So thanks a lot, Naval, for your compliment. I'm glad that you liked our performance. On the mismatch, I think 2-3 things which we should take a note of. One is whenever there is sudden increase in the input cost, considering the inventory which would already be there in the channel, we as a large manufacturer will have to pass on the increase in cost in a phased manner, which is what we did last quarter. You know this already, that copper LME increased almost by 15%, and same is true with aluminium from between Q2 to Q3. I don't think we are going to have a rerun of this type of increase in cost in the current quarter. And if that's the case, I don't think that we are going to witness similar trend what we witnessed in Q3. I think we should be able to come back to the regular contribution margins which we generally used to experience in earlier quarters. The other thing is, in our business, it's best to analyze our numbers on an annualized basis. And on an annualized basis, in the last few years, we have been able to maintain a better margin in cable and wire in around between 11 to 13%. And even now, despite facing a significant increase in raw material costs, we are fairly confident that we would be able to maintain that in foreseeable future. The second thing, on a consolidated basis, because FMEG margins are improving, we expect that overall margins should gradually start improving in the quarters to come. And your second question was around home, which is the IoT portfolio which we are in the process of launching. This, as you rightly alluded to, is for the premium customers who would like to have better experience in this digital era. We expect that margins are going to be better in this particular business. I think it would be too early to talk about the impact on the bottom line and top line, but we are very confident that this is going to be a game changer innovation product as far as our FMEG business is concerned. I think we should just wait for a couple of quarters and see what is the reaction of the market, and then from there we can further talk about the growth potential of this particular product. But there are only few companies where we have the complete FMEG portfolio under IoT, and all of our products are manufactured in India, and that is where we feel that we would be able to meet the expectation of the new age customer.
Understood. On this new brand, all these products will be manufactured in-house, or we are also outsourcing somewhat?
Almost all of them will be manufactured in-house, barring few where we don't have ready manufacturing facilities. So, for example, the large one, for example, fan, light and lume and all that will be manufactured in-house, switches and all that.
Got it. And lastly, as your cash generation has improved substantially, if you look at any thoughts on now dividend distribution policy, formal policy which can be announced in future, or how are you looking at dividend payouts? Can it increase with a strong cash generation also?
So now we already have a dividend policy. It is more qualitative policy and it doesn't talk about quantity at this stage. We are clear that as far as cash is available, we would like to keep it only for three things. One is for supporting our capex requirement. I alluded to defense and railway and others approval, and for export business as well as for supporting B2C business growth, we'll have to continue to make capex investment. So that is one area where we are going to, use our cash. The second thing is acquisitions. We have been actively searching for good opportunities both in FMEG business as well as on EHV side on cable and wire business. So that's the second area where we're going to use cash. After that, what is left, a part of it will be kept with the company for as a war chest, and the balance we would like to distribute to the shareholder. We don't want to increase the size of the balance sheet because that would adversely impact the return ratios.
Got it. Thank you and all the best.
Thank you. Thanks a lot.
Thank you. The next question is from the line of Atul Tiwari from Citigroup. Please go ahead.
Yeah, so thanks a lot and congratulations on yet another very solid quarter and good cash generation in the business. Sir, my question is on again the new product introduction. Okay, and this is more of a medium-term question. So now that you have fans and switches and water heaters also, so what is the next product we can look forward to? In terms of addition to the company's portfolio, like kitchen appliances, etc. Could you talk about how you guys are thinking about new product introduction over the next 2 years?
Thanks, Atul. Thank you for completing us on our performance. I'm glad that you are pleased with our performance. We would like to continue in the same product categories where we are present today, which is cable and wire and FMEG. We don't want to venture into product categories like, for example, you mentioned kitchen appliances, because there the GTM is totally different, the channel is different. We believe that we have enough scope to grow both domestically as well as in overseas market in both the business categories. On this product which we have just launched is IoT-based product. I think in the current digital age, all these smart products will continue to witness a fair amount or robust demand, and that is where we would like to bring more and more technology in our product offering. And second is what I mentioned to other participants. In the case of export market, we would like to ensure that we are able to increase our overall offerings in cable and wire business so that we are able to serve all types of customers across the globe. So that is going to be our focus.
Okay, thanks a lot. Very good.
Thank you. The next question is from the line of Chintan Seth from Samaksha Capital. Please go ahead.
Thanks, Gaurav, and congrats for a good set of numbers. A couple of things. One is on B2C mix for the quarter and the 9 months, and comparable YY number, if you could share that. Second is on the Ryker. How should we look at in terms of top line, which Ryker subsidiary can do? And thirdly, if you look at payables this quarter, excluding obviously the acceptances, our payables has increased a bit higher compared to if you look at our inventories on an absolute basis has declined. So if you can comment on how should we read that in the subsequent quarter?
Yeah. So B2C, I think, is hovering around 40% now. If we take the total revenue of the company as 100%. Last year it was in early 30s, probably 33, 34% or thereabouts. So there is an improvement in B2C contribution to the top line. On Ryker, the prime objective is to ensure that we have fair amount of stability on the supply side of copper, which is an input for us, and that is why we got into this business as part of a backward integration. Copper supply is not our core business. Since we have some additional capacities available, we are evaluating and figuring out what is the best way to utilize that capacity. But having said that, copper is not our focus area, and we would not like to get into copper business. Whatever numbers you are able to see now is just because we want to utilize the plant at a level where we get operational efficiencies and advantage. The third one, I think your question was around payables and acceptances. Working capital has been a focus area for us, and during the course of the IPO also we learned that one area in the balance sheet where we have to make significant improvement is working capital. Receivable I alluded to a while back as a response to another participant's question. On inventory, you would be able to recollect that we were working with a third-party consultant for augmenting the inventory levels, and you would be able to recollect in December 19, we were able to achieve a decent amount of progress on optimization inventory, but then it got slightly derailed because of pandemic and subsequent quarter. Again, in the third quarter, we ensured that we bring inventory back into shape, and all across inventory has reduced. And the absolute amount probably would just give you a small hint about the decrease, but if you actually play with LME, there's a significant amount of improvement which we have been able to register in inventory. In terms of number of days, it has reduced from 130 days to almost 109 days. Now what happens is when you are trying to optimize the inventory, you have to also slowly and gradually recalibrate your payable number, and that is where there is a slight mismatch as of the balance sheet date. But on a mid to long term basis, we would like to maintain inventory and payables and hand in hand. That would mean that the net working capital would be nothing but receivables, and to the extent we are able to further optimize the receivable numbers, we would be able to further improve the working capital which has been deployed into the company.
Right. And just a follow-up on this 40% is for the quarter or for the 9 months? B2C.
Yeah, I think for the 9 months it's 40%, but there's no significant difference even for the quarter. So ballpark, both the data points would take you to 40%.
And the Riker, we should look at 230 crore. There's an excess which we can sell right now outside of what we can consume internally, or this number can gradually, as we ramp up our manufacturing, this number will start to decline. That is what I was trying to understand. The 230 crore revenue we booked this quarter in Riker.
Yeah, so let me give you a broad big picture, and then we'll probably can draw conclusions. Riker has a capacity which is probably 2x of our current demand, and that is where the balance 50% capacity is required to be utilized in a manner so that we can reduce overall cost and increase operational efficiency. Whatever we are able to see here in terms of top line is because of that balance 50% getting utilized for things other than required for Polycab. Now, two things could happen in future. One is we are able to increase our consumption because of increase in our top line, and that is where we need not to operate Riker plant for third party supplier. Or second is we continue to utilize Riker plant by getting to third party tie-ups and all that. So that's where some work is going on. We want to ensure that backward integration helps us in bringing operational efficiencies as well as availability of raw material. And we will continue to challenge our thought process to ensure that we are able to maintain both of these things in our operations.
Sure, Gandharv. Thanks. I'll jump back into you. Thank you.
You're welcome.
Next question is from the line of Rahul Agarwal from InCred Research. Please go ahead.
Yeah, hi, good afternoon. Thank you so much for the opportunity and congratulations for a good set of results. So essentially my question was, I've been attending calls and listening to FMEG companies and who are unlisted, and essentially the common thread into that is gain of market share from smaller players. Unorganized markets, there have been some pre-buying as well because of price hikes taken in January, and a lot of market share gains which has happened from in these players. Overall in the FMEG space, I go through your website, I can also see appliances now, dry irons, geysers, coolers, pretty much a broad plethora of products into FMEG. So I just wanted to get a top-down opinion, as in over the next 3 to 5 years, how are we placing ourselves into the fans, lighting, and switchgear businesses, the larger segments basically. What's the real game here, and how does the market share eventually get divided? Because Crompton, Havells, KEI, a lot of cable and wire players as well as FMEG players are talking about market share growth as well as industry growth, which are much higher numbers. So that's my first question. Thank you.
Yeah. You know this already. We are the fastest growing player in FMEG. We've forayed into FMEG business almost 5.5 years back, and give and take few crores, we are almost 900,000 crore rupees top line FMEG player. Now, I think there are 2 or 3 things which we want to ensure. In the large product categories, we want to reach to top 3 market players in midterm. and eventually number one. Inder Bhai and other promoters, they ventured into the overall this business almost 5 decades back. We were no one when we entered this business, but slowly and gradually we became number one in cable business. Then in 1996 we started wires business, and now we are number one in wire business. So our DNA and our thought process is very clear that if we are in a particular business, we want to become number one. Now only time will tell that whether we are able to do that or not. But to answer your question, what is our overall thought process? Our thought process is get into top 3 players in FMEG business in each of the product categories where we have presence, and from there get to number one. To a certain extent, we have been able to do that in a few of the geographies already. For example, Northeast and North or East, where we have displaced the number 3 there, and we are inching towards number 2 and number 1. But I think at the country level, there is a long way to go, and we will continue to do that. And to support that, we have recently embarked on a program which is Sales Acceleration Program. This is the program where we want to ensure that we are able to expand the channel, we are able to meaningfully engage the influencers like electricians, contractors and architects. We have piloted this program already in 5 towns, and over the next 30 to 36 months, we would like to cover 300 towns, which are really important from the country's consumption point of view, and that would help us in further improving our FMEG as well as B2C penetration. This IoT product which I have talked about will take us to the premium segment where digital is important, and that will also help us in augmenting overall FMEG top line.
Yeah, perfect. Got it. So just to conclude this question, so basically on the new sub-brand which you launched, IoT based, you said it will be available online. Just 2 sub-questions to that. One is, will it be available on our own portal as well, apart from third-party sellers? That is one. And secondly, on the home side, how about servicing of these items, right? Because it needs a lot of customer service, post-sale, after-sale service, right? So just wanted to understand these 2 things. Thank you.
The second one has already been built in this product launch. So this will come along with a fair amount of service support and all that. On the first one, we are still exploring what are the best ways to do it. Certainly, it would be available through e-commerce as well as through our website, but we'll continue to explore and find ways and means to increase the reach of this product as rapidly as possible. And this experience centers which we launched around 12 to 18 months back in few towns of the country. These experience centers will continue to increase, and all these experience centers will also have all our products, including the IoT products, wherein the consumers can go and experience the product and then place orders online or through our website.
Got it. Thank you so much, and all the best.
Thank you very much.
Thank you. The next question is from the line of Viraj Mehta from Equirus Securities. Please go ahead.
Yeah, hello sir, and congratulations for the results. Sir, just wanted a breakup of if you actually take Dangote out, and if I were to look at the wires and cables business for the quarter, even taking out Dangote, then we seem to have underperformed the peers in terms of sales growth. Can you throw some light on that?
I don't think so. Are you comparing December 20 with December 19?
No. I'm comparing, the growth of December 20 on 19 vis-a-vis comparing it to peers. And I understand there was Dangote large in Q3 19, so I took out Dangote, I took out the export order and then did the math. Like one of the competitors grew 28% in terms of revenue. I think we are closer to 18-20. So just wanted to understand if there is any material increase in competitive intensity that you are seeing or anything else.
Yeah, no, I understand what you're saying. So I think before I specifically deal with your question, let me give you a perspective on December 19. December 19 quarter was one of the best quarters till that time, right? It was almost 2,500 crore rupees or thereabout at the company level. So we are comparing December 20 performance with December 19, which is a higher base, and that is where probably the conclusions what we are drawing is indicating that there is a degrowth. But if you see on a 2-year basis and on a normalized basis, across all the businesses, there is a growth. I think the FMEG business and retail wire business is leading the pack, followed by cable and wire export, and after that cable and wire domestic. The only degrowth or a flattish broadly number what we are able to see is because of cable history business. But other than that, there is a growth across.
Sure. And just one last question. If I look at your 5-year history or even 10-year history, you have grabbed market share from everyone. Your market share increase is the highest in the industry. Now the place that you are today with 14% market share or 15% market share, do you see that repeating over next, let's say, 4 or 5 years, that you grab the highest pie of the incremental market share? And if yes, what are the 2 or 3 major things you need to do to get that done?
That's a very interesting one, Viraj, and this is the question which internally also we are deliberating in our internal board and executive committee meetings. I would just request you to allow us a quarter's time. We are almost in the final stage of clearing our Vision 2025, and by end of this quarter, we should be able to finally shape it up. My sense is, my answer would be that we would be able to do it, and we would be able to do it in a very convincing manner. But if you are fine, I would love to come back to you in the next quarter and give you a more holistic picture of what Polycab would look like or should look like in 2025.
Absolutely. Would love to hear you. Thank you.
Thank you, Viraj.
Thank you. The next question is from the line of Chetan from AlfAccurate. Please go ahead.
Hello.
So Chetan, you may please go ahead with your question.
Hello, Ganesh. Am I audible?
Yes, you are, Chetan. Please go ahead.
Congratulations on a very good set of numbers. My question is primarily on the FMEG business. So, can you shed some light on the performance of the different components of FMEG business, lighting, fans, and other segments? And secondly, what would be the contribution of just the lighting in the overall FMEG, if you can give that number?
Sure. I think it's a case of growth across. In all the regions, we have been able to record a decent amount of growth, and it's broadly comparable. But if I have to pick up a particular region, it would be East, where the region has done slightly better than others, but it's comparable by and large across all the regions. If I talk about product categories, I think fan certainly is gaining momentum, and we are getting market share as far as fan is concerned. The second game changer business is lighting and lume, where we have been able to get to a very decent growth rate or revenue CAGR, mainly driven by distribution-led B2C business. And the third thing is the switchgear business. You would be able to recollect, and I talked about it in the June quarter, that we have realigned switchgear business to our real estate and wire business. The objective was to unlock the synergies, and switchgear business has a sort of almost 100% growth in the current period. So that realignment is giving us benefit. I think second part of your question was around the contribution. I think fan would be around 40% of our top line, followed by lighting and lume, which would be almost 30%, and then the other product categories, for example, switchgear and pipe would follow.
Okay. And lastly, in terms of FMEG business, so since we were new into this business, we had seen increasingly for a long period of time very high growth rates. But for the last quarter, I've been able to observe that our growth rate is broadly in line or slightly higher than our competitors, the larger competitors in the ECD space. So has the competitive intensity increased in the FMEG space, or are we focusing more on margin and reducing our intensity on increasing the top line, or what is the reason for this?
So competitive intensity was always there and will continue to be there. In whichever business you are, that would be there. I don't think there is any material change in competitive intensity between second quarter and third quarter. As a matter of fact, we are gaining market share across the board. And on a 5 years basis, I think our revenue CAGR in FMEG would be close to 45-50%. And I think that's a decent performance which we have been able to deliver. With launch of new products, we feel that we would be able to maintain a very good high growth FMEG vertical.
Okay. Thank you and all the best.
Thank you very much.
Thank you. The next question is from the line of Mudit Kapra from KEM Securities. Please go ahead.
Hello, good afternoon, everyone, and congratulations for great numbers. My first question is the breakup between wire and cables revenue, if you can share.
Yeah, so I think cable is now in early 50s and wire is now in low, around in 40s or thereabout. That's the thing.
Okay, thank you. And regarding Dangote, are there any follow-up orders beyond the $10 million which you mentioned earlier in the previous quarter? And if yes, till which quarter do we see these Dangote sales contributing to our top line?
Yeah, so Dangote, the first order we have completed the supplies, and after that we have secured a follow-up order. The supplies are expected to commence in the current quarter, but the first order has already been supplied fully.
Any updates over and above the $10 million order which you've procured in the last quarter?
No, nothing in addition to that.
Okay. And last quarter you also mentioned that you see growth in CIS countries in that region. So have you received any kind of business yet, and or are there any future prospects regarding this?
Yeah, I think we are witnessing a significant amount of traction across the globe, including the CIS countries. There is nothing material which has been translated into the P&L account, but overall there is an impressive flow of inquiries, and as I alluded to the overall export thought process, we would like to ensure that we maintain at least 10% contribution of exports to our top line on a sustainable basis. So including US and UK, other geographies, for example CIS, Middle East, Russia and Africa would be a major contributor to our top line growth in exports market.
Okay, thank you. And next question is on the numbers. We have seen our business increasing YOY, but there's a sharp decline in freight and forwarding expenses in our P&L. So any highlights on the same?
So that's a result of change in mix and the cost optimization initiatives which we have taken. That we started on a project Udan, wherein we want to optimize the cost, and this we are working with BCG. So across the P&L, we expect that slowly and gradually we would be able to optimize the cost base. The one which we are talking about is mainly because of change in mix. There is no significant other reason attributing to this movement in freight cost.
Okay. The last question is any updates on entering into EHV business?
That remains a priority area for us. Internally, we have identified an action plan to test this particular opportunity. I think by end of next quarter, when I come back to you with Vision 2025, I would be able to throw more light on this.
Okay. Thank you so much, and congratulations and all the best.
Thank you very much.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Gandharv Tongia for closing comments. Over to you, sir.
Thank you everyone for taking out time and attending this call. In case if you want to know more about our business, please feel free to write to investor.relations@polycab.com, and we would be happy to assist you. Thank you, take care, and bye-bye.
Thank you. On behalf of Polycab India Limited, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.